Probably I should start with a small introduction of myself. I'm Isaac Otolo. I head the transaction advisory business for PricewaterhouseCoopers in East Africa. East Africa for us has a very broad definition. So, other than Nairobi, where I'm based, we also have a presence in Tanzania, in Uganda, in Rwanda, and Zambia. And we also do quite a bit of work in the Horn of Africa, in Ethiopia in particular. I myself have been part of quite a number of significant transactions in this market. And the beauty of it, it's also allowed me to explore and see this country. So 10 years or so ago, when we were helping Heineken to acquire Harar and Bedele breweries, it gave me a good picture of the landscape at the time. And it's always good to come back and see the market evolve. And soon after that, when we then helped with the acquisition of Dashin by Duet and Vasari, it was again a key demonstration that there is capital that's ready to flow into the market. And I think a point to note with that, all those years ago, those were the biggest privatizations and FDIs into the market. Certainly, since then, we've seen quite a bit happen. What's happening in the telco sector in particular is quite exciting. And I believe with the steps towards developing the capital market, and I'd really love to see it go online from the beginning of next year, you're likely to see a lot more in transactions in the market. So I know there is pressure on time, so I'll try and go as quickly as I can. I think if we look at the region, Africa as a whole, and East Africa, what do we have going for ourselves to develop this investment banking industry? I think if we look at the level of FDI that is showing an interest in our region, and as Craig called it, we are part of the emerging market of the world. Investors are looking for different areas to place their capital. Yes, there is elements of risk, but you know the classic definition. With higher risk, there's potential for higher return, but also higher losses as well. But if we look at key sectors in our region, what are they looking at? Certainly in extractives, if we look at oil and gas, if we look at mining, if we look at the emerging industries around renewables, these are key sectors that have potential for growth. They will drive the next frontier for the world. And also, they do need quite a bit of capital to come into it. So the key question is, where can we raise capital for some of these interests? Can we mobilize that capital from a local perspective? And if we can, who should be playing in that particular space? So yeah, so I think there's key industries of interest. We also see healthcare, and if we also speak to the social good aspect of things, these are all sectors that require capital for them to be funded. There's potential to get that capital locally, but there's also an interest in getting it from outside. I've just spoken about risk and how that can actually drive the potential for return and the interest in the industry. But also beyond that, I think the fascinating thing that we see with our regions as well is the quick adoption of technology. We're getting digitized very quickly. Almost everyone has a mobile phone. If you look at some of the statistics in Africa, I think smartphone adoption is one of the highest in the world. And the beauty of that is even when you develop your stock market, then I would like to see the regulation allow for trading to happen off your mobile phone. And that creates the key factor around liquidity that's been spoken about by Craig as well as a key factor to drive transactions in the market. But what are the key attributes that we need to actually drive the investment banking sector? I think we've listened to a lot of this before. Macroeconomic stability and growth. Growth, I think, is a given. We look at this region in Africa, we probably have the highest growth rates in the world, both from an economic perspective, but also from a population perspective. But to drive that, we also need sound fiscal policy to come into play to drive the developments of the markets that we play in. I think we can't run away from regulation. We've all talked about it. But I think we shouldn't look at regulation from a hindrance, but it should be an enabler to actually get the market going. And some of the critical things that were spoken about. Can we allow the foreign investment to come in? Can we allow capital to exchange freely? Can we also control illicit flows into our markets to make sure that we are also still seen as a stable market and a reliable market for us to be operating in? I think licensing is key as well, and Dr. Brook talked about some of the thinking around that, and whether that is licensing for the investment banks themselves, but also from an individual perspective, to have individuals who are working in investment banks that are also licensed properly. Coming with that, of course, is the education, and I'm very glad to see the partnership with CISI coming into play, because they have actually played a big role in developing African talent and getting us thinking in the right way. I'm also very happy to hear about the education of financial reporting. I think in some markets I've seen very bad reporting around what's happening in capital markets. And if we can get our journalists skilled up as soon as possible for them to understand and perhaps even do their own research around how to report on activities that are happening in the market. If we look at the market opportunity, what investment incentives are there? If we're looking at issuers in several markets in our region, we do see issuers being given certain tax breaks, perhaps getting corporate tax at a lower level to encourage listing, perhaps also giving investors into stock markets some degree of tax breaks. And because, as we see in this particular region, a lot of institutional investors coming in from foreign markets, is there a way that we can encourage that by also throwing in some incentives around that? But as we develop the capital markets, I think it's also good to learn from what's happened in other parts of the developed or even emerging world. There are partnerships that we continue to see in the market. For example, the London Stock Exchange Group is quite active in Africa, helping with developing stock markets. There has been conversations with parties such as NASDAQ as well. And I think the key lesson that we have to learn as people operating in the region is that we don't have to start from the beginning. We can actually leapfrog a lot of the steps that people have taken and get us to a level where we are very digital quickly. We can do live trades quickly, but also we're doing it in a regulated environment to ensure that nobody loses their money, or at least not too much of it. So who are they? We've got the investment banks. We've got investment advisors, and I think it's important, as I said before, to also develop an ecosystem around advisors who can talk to the investing public, give them the right information about what they need to know about the stocks that they could be investing in, and to understand that it doesn't necessarily mean that every time you put your money in a stock, you're actually going to see it grow as quickly as possible and make high dividends or capital gains from it. Data and research, I think, is important. And I think that is another area that skills need to be developed as early as possible for this market, so that when we start to see activities in the market, people understand what's happening and the potential for those. And that also speaks to some of the elements that Craig mentioned around, can we get the entities reporting correctly from a financial reporting perspective? It's good to see the auditors board here. Can they also put to task their own auditors that to make sure that they're reporting in a correct manner? We need to get pension funds, savings and credit cooperatives, and other parties also well appraised of what's happening in the market. Do they understand the opportunity? Are the regulations there to facilitate them investing a good amount of their money into the market, and to understand the risks of actually doing that? The challenge I actually see in a lot of this region with pension funds is education on the trustees. Trustees tend to take a very risk-averse perspective to investing in equity capital markets. They're safer with government paper. The risks are risk-free in principle, and probably will even go for property-type investments where they see the title deed. They can see them selling the properties out of that, but not getting a full understanding of investing in more exotic stuff. Talked about issuers and governments and corporates in particular. The opportunity with state-owned enterprises is huge. As Craig said, in emerging markets, typically, you do see a big driver for the stock markets coming out of these. And can we prepare our state-owned enterprises here to be adequately ready to list on the market. And I think even from a national pride perspective, it gives individuals the ability to actually own some of the enterprises that the country owns. And what we do see in a lot of the markets, if we look across East Africa, some of the most highly traded stocks, the most liquid stocks, and the ones that have actually gotten the highest capital gains are formerly state owned enterprises that have gone into the market. And I think there's a feeling from the public that they do understand these institutions, they have seen the history, they've probably played a part directly that they can see around development of the country. And that's why they end up in the market. And of course, there's a role of commercial banks. They hold a lot of our money. They hold our savings, and I think there needs to be a coexistence between them and the rest of the market to actually understand how does the capital flow between the two types of institutions and ensure that the investing public can still participate in both. So they should ideally be able to facilitate the same way the investment banks should be doing so. But if we look at what would be the drivers of value as we go forth, mergers and acquisitions, we're already seeing a lot of that activity in this market. How do we then translate that into listings, whether those are IPOs, secondary offers, as we typically see in many markets, and gradually moving to debt issues, whether that's the government actually creating an environment where those issues can happen on a regular basis, but also corporate issues that do happen. And then there's a whole aspect of underwriting. Again, we don't see much of this happening in our markets, but there is potential to actually grow and move in that space. But at the end of the day, what we're trying to do is create a system, create a market that will develop over a period of time. We're not going to see all the fancy and big transactions happening very quickly. It will take time, but we need to take the space, and we need to have the market develop gradually and as soon as possible. If we look at some examples of what's been happening around the region, I've just put a flash of some of the players that we see in Africa. ABSA, based out of South Africa, on their investment banking side, are involved on several transactions, big ticket, not just in the southern part of the market, but also doing a lot of cross-border transactions across the region. I myself have worked on them on several transactions across the region, and you're probably going to start seeing some names like this come into play. On the Nigerian side, they've been able to develop a number of big local investment banks over the years, and again, driving a lot of the deal flow that you see on an investment banking perspective on their side. And if I look at Kenya, you do have a number of investment banks that actually evolved from being investment brokers initially and then getting to the point where they can raise their capital under the facilitating regulation to then become investment banks. And I think those are probably some of the transitions you'll probably see here. The key question with capital, especially when you don't see many transactions happening in the market, is we are going to park a certain amount of beer in capital to be able to get a license, but how do we actually use that capital to do business? And I think the quicker the market evolves, the quicker that capital becomes more useful to these players and for them to play in a bigger role. If I look at what's happening on a regional perspective, we don't have a lot of the big names that we would have seen on Craig's list, but there is interest from large investment banks in the region. So if we look at RMB out of South Africa, they're increasingly opening rep offices across the continent, and they do see a play of larger transactions where they can bring in perhaps some of their capital and some of their higher net worth clients to play in this market. Standard Bank or Stanbic Bank, as it trades outside of South Africa, is also quite active in the investment banking market, and we do see them playing quite largely. And we've also seen JP Morgan doing the same thing, where they're actually opening rep offices across the region. So that's probably the future of what we see. And if we see the big names looking at this market, it's an indication of what we see potentially happen. And they chase some of the money that they see coming from their own markets. If you look at BlackRock, they've recently made a significant transaction into this part of the world. And you're starting to see more of those types of names now looking at East Africa a potential investee market. So, what's the pathway for Ethiopia? As I've said a lot, privatizations. I think that will be a key driver for the IPO market. We've seen that across the region. If you look at Kenya, the bank like KCB or the big utility like Kengen, big players in the stock market and did a lot to create the vibrancy there. If you look at markets such as Uganda, the same Uganda Commercial Bank that's now Stanbic is the biggest trading bank on the stock market in Uganda. Tanzania has very similar stories also with previously state-owned institutions that are now the biggest traders on the listed market. There tends to be a big bias around financial services, but again, it's an institution you probably deal with on a daily basis. The investing public understands it, and you can watch. And given they're also regulated by other strong regulators, there tends to be a lot of confidence in them. The corporate bond market is again a potential for the growth of the capital market in the region. We don't see as heavy activity as we see in other mature markets, but there is potential. The good thing is that you don't necessarily have to be listed in many markets for you to actually put your bond in. We've seen some activity from DFIs such as Shelter Afrique, for example, who've then gone on to list bonds on the markets. And that also enables them to attract local currency so that they can fund activities in those local markets. Municipal bonds, again, are a potential, although typically these then still need to be guaranteed by the sovereigns of the countries in which they operate. But it also gives an opportunity to, again, bring that social good where the municipalities are able to raise capital locally and run their own development opportunities in their own markets. If we look at local and foreign participation, I think there's a need to open up the capital base and see how to facilitate both local money and foreign money coming into those markets. In many of our markets here, as I said before, foreign institutional investors are big investors. They bring their money in. They need to have facilitating forex regulation for that to happen. But there's also a challenge when they need to take their money out as dividends or as getting their capital out. It needs to be in a manner where it is easily facilitated. And I think the last bit of it, as I've said before, robust regulation. That is key from a fiscal, from a tax policy, from an investment regulation perspective. And that will be one of the key drivers to get the markets to where they need to be. But I think Ethiopia is at a prime place. The potential is huge. And as I said, Dr. Brook, the challenge is on you for next year. But I think you will see there the potential activity that the market has. I think I'll pause there. Thank you.
Thank you, Isaac. Let me hold you here for a quick second. There are two questions from the audience, and then I'll allow Isaac to respond in 2 minutes if possible, and then we'll take a health break. The first question is, what comes first, investment banking or the actual availability of enough buy side and sell side to justify investment banking? That's the first question. And second question is, what are the key learnings and takeaways from Kenya and from the Eastern African countries in regards to investment banking for Ethiopia?
Right, both tough questions. What comes first? It's almost a chicken and egg type question. I think they both have to start together. The corporates, the SOEs that are thinking of going onto the market need to get the right education around what needs to happen for them to go there. As I've talked about, facilitating regulation. Is their accounting done right? Are they audited from a reputable perspective? Do they understand what it means to be listed in the market and the corporate governance requirements that come with that? So I think that's critical, but also the investors. So if you're talking about the pension schemes, if you're talking about other institutional investors, if you're talking about the public themselves, do they understand what's coming and do they understand the implications of operating in this asset class? So I think they both need to happen at the same time. The investment bankers will come, they'll see the business opportunity, and they'll prepare from that perspective. I think I mentioned some of these points as part of my presentation. Uh, a lot of the market activity we've seen in East Africa has been driven by large listings that are driven by state owned enterprises going private. But for that to have happened, the public needed to have understood these companies. They needed to understand the process of investing, the valuations. So there's no point coming into the market and saying you're going to sell each share initially at 1,000 birr. Yet the typical investor would be looking at it from a perspective of saying, I think a 20 birr per share level is the right level for you to go. Valuations are critical, and I always have big debates around valuation across this market. What is the right valuation to go into the market? Are we going to go at a premium? Are we going to go at just the right valuation, or may even consider a discount looking at the potential for the market? But that market making aspect that Craig also mentioned is critical in you actually enhancing the activity. So SOE is a big. The corporate bond market has its ups and downs. We've seen some large corporate issues that have come into play. And as I mentioned, in some cases, we've got DFIs like Shelter Afrique that have also come in to raise local currency in the markets, but also to spur activity in those markets as well. So there needs to be a joint play between different players in the market to actually drive it. But certainly, if the public understands it, if the pension schemes understand it, if the international investors understand it.
John Piermont Morgan left his job from a bank because he started selling commercial paper on a coffee that was imported at the port of New Orleans. It was a risky venture. Everybody shied away from that. Luckily, he was able to go through his Rolodex of investors, was able to sell all the coffee and made a slight profit. And because of that, he had to lose his job and he ended up going ahead on his own and started off the John Pierpont Morgan Investment Bank. Goldman Sachs has got a similar story. These two names still survive the test of time. They survived the Great Depression. They survived the global financial crisis. We know of the casualties of the global financial crisis. That was Lehman Brothers and Bear Stearns. And now, recently, we lost the Credit Suisse. The key takeaway from that is this is going to be a long journey. It starts small, it starts at a basic level, and it grows eventually. And regulation is the key for that.